Hello everyone, my name is Dhruv Sahani, and in the course of financial management, today we are going to discuss the concept of shares and dividends. Shares are the units of ownership interest in a corporation or financial asset that provide for an equal distribution in any profits. If if any are declared in the form of dividends, the two main types of shares are basically common shares or equity shares and preference shares. Debentures. Debenture is a type of debt instrument that is not secured by collateral and usually has a term greater than 10 years. Debentures are backed only by the creditworthiness and reputation of the issuer. Basically, shares are the units, basic units. Shares are like the shareholders are the owners of the organization, you can say, and debenture holders are the creditors of the organization. Shares and dividends. Basically, the features are long-term finance. These are used to raise long-term finance for the organization. Funds owned by the organization and fund borrowed. Funds owned is like shares, and the funds borrowed are debentures. And capital raised is through shares and retained earnings. Features of dividend: a source of major investment income for investors, redistribution of profits to shareholders leading to an encouraging announcement of health of the organization. Basically, when the firm provide dividend, it helps the shareholders to see that yes, our organization or the company in which we have invested is working good and is up to the mark, and mostly paid in cash or further shares of the same organization. Basically, when the sometimes when companies earn profit, it provides bonus share to the shareholders as well. Now, types of shares and features we are going to discuss about. So first is equity shares. These are the basic shares like considered for profit sharing after preference shares and debentures payment. Having voting rights in the organization, they have no period of maturity, no legal obligation for payout of dividends based on discretion of management. Sometimes the profits are retained for reinvestments. In case of a loss, the net value of loss is to be shared amongst the equity shareholders. Rights of sale and transferability of shares as well as residual claims on assets while winding up. First hand right over any future subscription of shares. Like if the company will float any new shares, equity shareholders will be having the first right to buy them. Preference shares. Form of debt for the organization. Basically, limited voting rights are provided, a fixed rate of return is provided, it has an appropriation over generated profit, prioritized above the equity shareholders for dividend and asset distribution, fixed tenure of redemption after a period of 20 years, may or may not be converted into normal equity shares, transacted via stock exchange, provides protection to investors against fluctuation in value as it provides a fixed dividend. Like in case of debentures, we pay the fixed amount of fixed interest. Here in the preference shares, the fixed dividend is provided. Redeemable shares provides a maturity value at the end of a stipulated time period, redeemed against equity or by creation of separate fund known as capital redemption fund out of the profit loss account. Irredeemable shares aren't refunded to the investors during the lifetime of the organization. No organization can take up the provision to provide non-redeemable shares for a period more than 20 years. Cumulative shares. In case of negligible profit over a financial year, the dividends are not distributed in the current financial year, instead paid over a period of few financial years. However, in the case the company doesn't remain going concern, there is no obligation of paying up cumulative dividend. Non-cumulative. If dividend goes unpaid over a financial years, the shareholders have no obligation to be paid for any year's dividend. However, they are entitled to the obligation of getting back the invested capital at par with the preference shareholders. Convertible and non-convertible shares. Convertible shareholders are entitled to convert their shares into equity shares with a stipulated time frame. Non-convertible shares aren't convertible to equity shares. Participating and non-participating. Entitled in surplus profits apart from a fixed shares of dividends to be paid out at the end of each financial year. There is an agreed upon ratio as stated by the organization in terms of dividends paid out through the equity and participating preference shareholders. Participating shareholders are also entitled to share over capital assets as the part of liquidation. Participating shares are preference shares with a fixed rate of dividend, neither entitled to a chunk of surplus or valuation of assets after the phase of insolvency of the organization. Guaranteed. The form of preference shares that basically come with the backing and an understanding that the shareholder would be paid up to a fixed dividend irrespective of the financial position of the organization. This is same as the debentures, these guaranteed shares, but there is a difference is just that the debenture holder do not have any voting or rights in the organization, and the preference shares do have.